Hello and welcome to MF Corner. I'm Sonal Bhutra, and today on the show we are going to discuss something that everyone's been talking about, what's happening in gold and silver prices. To discuss that, we are going to put the spotlight on Bandhan AMC's new fund offer, which is Gold ETF Fund of Fund and Silver ETF Fund of Fund, which opens on 12th of January and closes on 20th of January for subscription. We'll focus on investing in these two funds. What is the outlook going forward? Why one should be investing in these funds, and what is the outlook going forward? Whether there is more legs to the rally. With our guest today, Gaurab Parija, Chief Business Officer at Bandhan AMC, and Sachin Jain, CEO at World Gold Council. Gentlemen, good afternoon. Thank you so much for joining in. We have been talking about record highs on gold and silver every day. Actually, it's been a one-way rally. So there is the ETF or the ETF fund of fund that has been introduced by Bandhan AMC. Gaurab, the question is to you now, because silver and gold are already at record highs. Why an FOF now? And do you think the timing is correct? Because it has already surged big time in 2025. Do you expect similar returns?
Firstly, thank you, Sonal, for having me back on the show. It's great to be on the show. It always seemed to be starting off with a trick question to me. So let me take it step by step. First things first, I think as a fund house, we always believe that fund launches are not basis the timing of the underlying pricing, but more importantly on the sustenance of the theme, and believe that this theme is going to be lasting for a long period of time. And hence the timing is more incidental. Like you rightly pointed out, it appears that the prices of gold and silver have rallied significantly. And like any other asset class, if there is a sharp movement in prices, there could be a potential time correction or a price correction, and that can't be ruled out. Having said that, I think it's also important to know that traditionally, when we looked at both gold and silver, we used to treat them as hedges against inflation, currency, geopolitical risk, and all of that. But given that the central bank has been, most central banks have been starting to buy gold, I think there's clearly a structural shift in the way we need to look at these asset classes. And I think the point we're trying to make to investors is please look at these asset classes as a long-term allocation as against a tactical play. And hence price movements in the short term need to be not looked at in too much earnest and look at it more from a long-term play.
Okay, so one should look at these two funds from a long-term perspective. Sachin, let me come to you in that case. Do you expect gold to see similar returns that we saw in 2025? If not, what are you expecting, and what could be the triggers this year? Because globally, geopolitically, it's been volatile every single day. What's leading to the returns or the record highs that we're seeing now?
So first and foremost, my big thanks for having me on your platform, and it's always a pleasure. Well, the fact is that over the last 18 months, we've seen 83 all-time peaks of gold pricing. And the earlier conversation, which I would agree to my previous speaker around central banks buying, that has been continuous. We've seen the interest of investors in the asset class over the last year. So all those things are good. But if you ask me around the principal triggers of why this is happening, I think it's almost underlying now that the reason of this has been the global debt, and also particularly the US debt, which tends to be at a very critical stage. And that, alongside with the geopolitics, with, of course, a lot of tensions, trade wars and everything. And if you look into the future, I mean, as World Gold Council, we don't predict a price, but we can certainly give you scenarios. And if you look at the three scenarios of very positive, mild, and something which is negative, I would say that if there's great peace in the world and the leadership of Russia, China, America become great friends and lead the future, yes, the price of gold might drop. If you think that there'll be excruciating wars, which could be the second scenario, then price of gold might go astronomically high. And both these scenarios seem very unlikely. What seems to be the situation is be somewhere in between, where we think that the global debt, which is the principal reason why we see what we're seeing in gold, alongside with the current geopolitics, which is the new way of living that we have. I think in that perspective, the pillars on which the price of gold is built on are certainly in favor of gold.
Okay, I like how you put it, the new way of living, because it's a new way every day and new levels on gold every day. Gaurab, you did indicate that yes, there will be some time correction, there will be some value correction we could see. But are there enough triggers in place in at least 2026 if somebody is looking at investing in the ETF, FOFs today? Do you think 2026 is not the year they should be looking at major returns come by for gold and silver?
Sonal, I think, like I said, forecasting 1 year returns is going to be very dangerous from all perspectives. I think investors need to understand why are they allocating to this. And if you have to look at most investors' portfolios, we think they are underinvested to both these asset classes. Do remember, like what Sachin said and what I've been saying, we believe there are now structural changes in the global economy, which is leading to both these commodities doing well. If I have to look at gold, it's now clearly coming through as a store of value. If you have to look at silver, we find that silver is now playing on two aspects. One is industrial use and one is the precious metal use. And increasingly, what we find is that the consumption of silver is now 60% of industrial across EV, electronics, and all of that. So I think more than just a pure play ornamental slash precious metal play, I think there are structural changes which is coming through. And hence, one believes that this needs to be more of a strategic asset allocation as against a tactical asset allocation. And again, I reiterate, and the cost of repetition, I don't think we should be looking at near-term price movements to determine whether we should be investing or not.
Okay, all right. Gaurav, I'm coming back to you because, this is a much discussed conversation and much discussed commodity, both gold and silver, because retail investors, they often enter silver and gold after sharp rallies. Are there any signals they should look at to understand that prices are already overheating? Just for knowledge perspective, I'm not talking about whether they should invest or not, but if they need to understand the market.
It's back to the same fundamental question of what is the right price to get in. I think I'll leave Sachin, the expert on gold, to talk about gold. But if I have to look at silver, increasingly what we find is that because the supply of silver is getting limited because mining is limited, silver is a byproduct commodity and hence that's also getting limited. A lot of countries are now trying to protect precious metals. Fortunately, unfortunately, the use of silver or the substitute for silver is very limited. So hence, I think silver is not going to be easily replaceable. And one of the aspects also to keep in mind is as gold prices go significantly high, we think the next preferred option, even from a precious metal perspective, is going to be silver. So one believes that there is enough and more room in both the asset classes and commodities, but what exactly will pan out over the next year is a very difficult call to take. And hence, I won't be betting my neck out in saying that, look, next year would be either positive in a significant manner or you could see a significant downturn.
Of course, it's very difficult to predict moves considering the volatility that we're already seeing in global markets. But Sachin, coming on this, you must be getting this question already, right? What is the right time to enter? Of course, there's no right answer for that. But how can one at least understand some signals whether prices are already overheating? It is not only from an investment perspective. A lot of people do it for personal consumption as well. So what is an answer to that?
Well, I think I'll agree to Gaurav here because there are two things that one needs to keep in mind. We at Global Council always recommend that in your diversification strategy, gold should be between 10 to 15%. And we've also realized that while we all have a certain belief that gold is a part of my portfolio and henceforth, but we realize that the investors have gotten very sophisticated over the last 4 to 5 months. And people are generally getting to that level of 10 to 15%. And that's a great figure. And it does a great health to your portfolio at that level of diversification is one. But if you look at the lens of investing in gold, at what price and so on and so forth, I think gold has to be looked at from an extremely long-term perspective and what it does to overall portfolio. Gold certainly isn't a case where you invest today and want to get some returns tomorrow. That will, of course, risk out your sort of portfolio's overall health. So my bits are a long-term strategy, look at that. And when you look at diversification, decide a number, whether it's 10%, 15%, or whatever it is, but then get to that number in products like perhaps EDF and other ways.
Okay, all right. Take that point, Sachin. Gaurav, let me come to you for silver now, because that's another commodity that surreptitiously saw that increase and not spoken about so much. You highlighted 4 consecutive years of global silver supply deficit. We saw that in 2025 as well. How much of this deficit is structural versus cyclical in nature? And is this expected to continue now that we are continuously seeing higher demand in the industrial segment?
You're right. I think silver has seen a multi-year supply deficit, and we honestly believe that the supply deficit is now predominantly structural and not cyclical. And this is coming through because of the long-term demand of silver. Like I stated, silver is now increasingly used from the industrial consumption as also from a precious metal perspective. Mining of silver is getting very, very limited for multiple reasons of economic reasons, regulatory reasons, and hence, and silver is also a byproduct of it's also a byproduct commodity. Given all of that, we think the demand will continue to outpace supply, and hence the leg or the price movement of silver, there is enough and more scope. Given that this metal is used for both industrial and the precious metal, the volatility of this underlying commodity is going to be higher than gold. Because as economic cycles across the world move, industrial growth would be impacted, and hence the underlying commodity used in that could be impacted. And that's where I think silver would tend to be a little bit more volatile than gold in the long run.
Okay, all right. Take that point. I have a lot more questions on both the commodities because it is the hot topic. But gentlemen, I have to slip into a quick break. On the other side, we'll continue our discussion with Gaurab and Sachin on what kind of portfolio allocation an investor should have and what is the outlook going forward. Stay tuned for that conversation. Welcome back. You're still tuned into MF Corner. Still have with us Gaurab Parija of Bandhan AMC and Sachin Jain of World Gold Council. We are talking about investing in gold ETF fund of fund and silver ETF fund of fund offered by Bandhan AMC and understanding the entire fundamentals around gold as well. Gaurab, let me start with you first. In the presentation, you've spoken about how the gold-silver ratio is currently well above its long-term average. Is this a metric a retail investor should be looking at every time when they're making allocation decisions? How does it help them?
So firstly, I think investors need to look at their portfolios as against looking at what your neighbor is doing. I think you need to understand where you are invested in your portfolio. Let me make a confession that over the years, one has always believed that gold and silver are not growth assets and hence only provide hedge against inflation. And so typically, we've tended to underinvest in these asset classes. But like I've said, over the years, given that what's happening geopolitically, how central banks have moved from holding dollar versus holding gold, I think this strategy is not going to hold forth. We believe both gold and silver are now more strategic asset allocation, and hence you need to have it as a core portfolio. Depending on what your underlying risk need is, underlying risk profile, the percentages can vary, but looking at a broad metrics of ownership of gold and silver in the overall economy, I don't think is a right starting point for making an investment decision.
Okay, all right. Sachin, coming to you, we are talking about how 2026 could be different than 2025. We really don't know. But what are the biggest risks an investor should keep in mind while investing in gold at this point in time?
Well, I think there are a few things that one should know that are happening structurally also on gold. And new consumption areas are coming up. Like this year, we've seen the demand for technological products has crossed about 8%. And this is largely to do with the artificial intelligence chips, the fast-paced artificial intelligence chips that are getting more and more democratic. And we foresee this, getting more and more strong as we go forward. There are two other areas. I mean, China government has opened up the investment of the insurance sector into gold, which is a very new development. They've started with 1% of the AUM, and we believe that's going to continue. In the Indian perspective, having very detailed conversations with the insurance sector, also the provident fund sector, where there's openness now to invest in ULIP via gold. So there's some new areas of development coming up. But I think I again repeat what I said before, that when you look at 2026 and beyond, one should look at balancing your portfolio scientifically and not just for the perception, and see whether your portfolio has between 10 to 15% as minimum on invested in gold, because that's going to do good to the long term. And secondly, have a long-term view in mind. Gold is certainly not.
That has worked, right? The long-term view has worked for every investor who's invested in gold. There are no two ways about it. It has seen stellar rally in last couple of years. So Gaurab, in your case or in your mind, in portfolio construction terms, you're saying it is the strategic part of any portfolio. What is a sensible allocation range to silver and gold for a retail investor? Is this 5% idea or a much smaller satellite exposure? Or do you think, as Sachin says, it should be at least 15 to 20%? But again, it's different for different people. But what would the common idea be here?
So again, Sonal, I won't say one size fits all. If I had to take myself as an investor and I'm at 54, and I believe I'll live till 100 years. That's another 40 years of survival. I would now tend to have 15 to 20% of my portfolio now into these two asset classes. Given the runway of 30, 40 years of my portfolio, I think it's a decent allocation. Now, clearly, like I said, depending on what you're investing for, the allocations will change. But if you're looking at a long-term perspective, and like Sachin alluded to, I think it makes sense to have anywhere between 10 to 15% across the two commodities. And again, personal preferences could have someone investing more in gold over silver.
Okay, so in that case, how does a silver and gold ETF fund help investors who do not have demat accounts? Some of the trade-offs they should be aware of compared to a direct silver or gold ETF.
So I think rightly said, buying through an ETF requires you to have a demat account. And if you look at the number of demat accounts in India, it's still very low. What the ETF FOF structure does is it brings all the advantages of convenience of a mutual fund into play. So you could literally start minimum investment of 5,000 rupees. You could choose to invest to a SIP mode. You could choose to do a systematic transfer. Subsequently, when you want to withdraw from these two asset classes, you could choose to do a SWP. Secondly, given that these are mutual fund structures, from a dashboard perspective, from your view, the perspective of seeing all your investments in one, this is the same as any other mutual fund. So I think from multiple perspectives, while ETFs are very much suited to institutional investors who have the ability to trade in the markets, I think for a lot of retail investors, the ETF FOF is a far more convenient and superior alternative to investing in the underlying asset classes.
Okay, all right, take that point. For most of the commodities, it does work that way. Sachin, you have been at the helm for such a long time, right? You've been speaking to more retail investors, institutional investors. What are some of the common misconceptions that you've seen which people have when they go buy gold, be it physical, or now we have so many digital modes as well, right? We have sovereign gold bonds, now we have mutual fund products as well. What is it that your discussion with clients or with retail investors or institutional investors indicated?
Well, actually, there are a few things. One is that, there is always a sort of belief that when you buy physically, are you losing money? What's the making charges and all of those things? But I think there's great effort done by BIS on mandatory hallmarking of jewelry. And now there's also going to be mandatory hallmarking on bullion, which of course gives that comfort. But I think the investment areas like ETF, for example, as a product, if you look at the AUM over the last couple of years, 1st of January 2024, we were at an AUM of about close to about 56 tons. Right now, we are almost surpassing 95 tons. And that's purely indicative of a younger India, a more confident India digitally, and with such a superior product which is regulated and backed by physical gold. I think it still lacks the education and the awareness. And products like ETF will perhaps grow leaps and bounds as we go forward. So I think I would say that from misconception perspective, it's about transparency, it's about confidence, and also lack of awareness of products like ETF, which are going to really do really well, I believe.
Yes, that's what we are discussing with guests, experts on the show as well, to make them understand this different idea of investing into products, be it, some precious metals, some sectors specifically. But thank you so much, gentlemen, for joining us today, explaining to us the aspects of this ETF fund of fund and also gold generally, because this has definitely been the talking point of late. Thanks a lot for your insights today.
Thank you very much. Thank you very much.
Okay, all right. With that, we'll take your leave on this edition of MF Corner. But before that, since we are talking about gold, you have to take a look at what the gold ETF flows looked like in the month gone by. That is the month of December. We got the AMFI monthly data last week. And gold ETF, those numbers are at a record high, 11,646 crore rupees. That's a 3-time or a 4-time jump that we are seeing on a month-on-month basis. This number is at a record high, shows the kind of interest that we are seeing in gold and gold products as well. And that's the reason we thought it's a good time to have that conversation with Bandhan AMC and World Gold Council as well. With that, we'll take your leave on this edition of MF Corner, but stay tuned for Closing Bell to take you through the last hour of trade.